Hello, everyone, and welcome into Crush the Street. I got a really exciting interview that I recorded this week with Peter Hugg of Kitco, and I just wanted to be upfront and let everyone know that it was recorded earlier in the week. So we've seen a big move in gold and silver, gold hitting 1900, silver hitting $23. So a couple of the things that were said were prior to this move. So just wanted to be upfront with everyone on that. Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and we are now in July of 2020. The virus is still plaguing at least the headlines, and some people are being affected by it, certainly. And then there's a lot of stories, and we don't know what to believe nowadays. I mean, from the economy to precious metals to stories on the virus, the illnesses, the remedies, all of these different things. It is just quite the circumstance at the moment, and something that I don't think anyone really could have predicted in January of 2020. My goodness, the way the world has spun out of control. We are in a new universe at the moment. We're going to be discussing the current environment right now with Peter Hugg, Director of Global Trading at Kitco Metals. He's a returning guest and someone that we've looked to for a great amount of insight on what is going on in the market. So quite the different environment from the last time we talked, Peter. Peter, thank you so much for coming on the line with me today.
Pleasure, Kenneth. Nice to be here again.
Well, you've been working in the precious metals industry since 1974, basically since the start of the new form of the dollar that we still use today. U.S. stocks opened lower today as the country's biggest banks took a massive hit in their second quarter earnings from this COVID-19 pandemic. And it really does seem like it's going to take some time for the damage to really settle into the economy, whether it's going to be felt from future earnings, inflation numbers, or what have you. I'd like to get your thoughts on, what's happening this year, from January into February. What is your overall sentiment at the moment? And we'll dive in a little deeper from there.
Well, I think, hindsight is always 100% correct. I mean, but, when we were back in March, April, when they first closed the economy, I mean, obviously the immediate impact was, a 10,000 point drop in the Dow. And that reversed fairly quickly when people realized or believed that this was strictly a health event, and we'd come out of it the other side fairly quickly, and the economy would rejig. And stocks had lost anywhere from 50 to 80% of their value, and we got that bounce. And it looked when you were watching the stories coming out of New York that they seemed to get a handle on the virus, and the slope came down, and I just think there was general enthusiasm on that basis that we were sort of going to come out of it on the other end. And given the stimulus that the Fed has thrown into the market and the government, to the tune of about $3 trillion combined, that this money had to go somewhere, and it was going into the equity markets. Now, obviously, very recently, and by recently, I mean over the last 2 weeks, it's starting to look a lot gloomier again, with the outbreaks in some of the states that opened early, specifically, Florida, Texas. There's a few of them anyway. Florida, Texas, Arizona, and California yesterday announced that they were basically going back to about an 80% shutdown mode, and that's the largest economy in the U.S. You would expect under those circumstances that the stock market would have taken it on the chin, and there was an immediate reaction. The stock market gave up about 400 points of its earlier gains yesterday and closed flat. This morning it started off lower with the bank earnings, but that was to be expected. And right now we're looking at the Dow up about 170 points. So in the overall context, I am concerned about the equity market's valuations at current levels. Prior to COVID, the market was trading at about a 19 multiple. It's trading at about a 23 multiple now, with 40% of the economy still pretty much shut down. So I'm having trouble understanding the valuations. So I'm a little concerned about the equity market at these levels. I think it's ahead of itself, and I think it's going to take considerably longer for this economy to turn itself around and be an economy that we saw, let's say January, February of this year. I think that's at least a year out. Even if they got a vaccine, I think before everything rejigs and the logistics and the supply chains all get back into line, people get rehired, I think that's at least a year out. So I think we're in for more pain in the short to intermediate term. And then it really depends on how we come out of this as to whether this, the economy will be able to, grab the same type of energy that it had in January, February with, a 3.5%, 4% GDP. Unemployment at 3.5% is a dream. I don't think we'll see that again for the next 5 years minimum, maybe 10. So I think there are some issues in the economy, but the upside to it is, and I don't know if this is an upside, is that the central banks, obviously the Fed, but the central banks globally are totally committed to throwing as much money at this problem as possible. The fact that the Fed came out about a month ago and indicated they were going to keep liquidity in the market until at least 2022. I mean, that's just an unprecedented statement that they would go out that far. So there's going to be continuous liquidity in the market, which should create a floor to the equity market. But on the other side of that equation, I think is very, very bullish the precious metals.
Yeah, that's what I want to get into now. I mean, the inflation side of things, the money creation that we're seeing is really unprecedented. The CARES package that was thrown at this situation. I mean, it's bigger than, the cost of World War II. I mean, inflation adjusted. It's just, you can't even wrap your mind around it. And to even think about what the next crisis might look like following this crisis, it's just beyond comprehension. It's like thinking about God and space and who created what. And it just like really starts to blow your mind when you think about it. But so talking about precious metals, I mean, being the global trading director at Kitco, talk to us about what the boots on the ground is like right now for gold, for silver, what you're seeing, and where are we in this bull market for gold? Because obviously things are well on their way.
Well, to give you some a bit of perspective, first, back in April, March, when COVID was first announced, the first reaction in the metals was exactly the same as the reaction in 2008. And that was a move down. And that was people, investors selling their precious metals to raise cash to chase the stock market. They thought that this would be a temporary blip, which it ended up being. But they were chasing the stock market down those 10,000 points. And they were obviously also really concerned about the closing of the economy, so they were raising cash. So the first reaction, when you get sort of an issue, an economic issue, like we saw in 2008 and like we saw at the beginning of the year, this year, is that there is a rush to cash. But once that initial surge is over and people sort of reevaluate the scenario, and then the Fed comes out and says that they're going to be pumping in $2 trillion or $1 trillion, and the government's going to pump in $2 trillion. That was basically the green light for the metals. And at that point, gold was trading, if I remember right, somewhere around $1,500, and silver was down just in the mid or low $14 range. I think it might have just dipped below 14, but only for a day. We came out at that time with an extremely bullish call. I mean, I was calling for gold to test the 2011 high, which was approximately 1925 by the end of summer. And we thought silver would at least be at 1925 by the end of summer in that scenario. And the reason we were a little bit more conservative on silver was because of the global slowdown in the economies, silver having usage as an industrial metal, that we saw that demand ebbing, and therefore did not give silver the same type of legs that we attributed to gold. Now 2 days ago we got to 1825 on gold. We had a pullback over the last couple of days under 1800. Today it's back at 1805 as we speak. Silver hit our target of 1925 yesterday. Came back again down under 19 overnight, but is back now in roughly around the 1910, 1920 range. So we continue to be constructive this market. What concerns me in the very short term is at the end of this month, what the government is going to do with the stimulus package. Are they going to extend that unemployment, the federal unemployment package, which really, in my opinion, was a disincentive at $600 extra a week over and above state unemployment payments? It basically was a disincentive for individuals to go back to work. So even though the restaurants and some of the events were starting to open and trying to open, the staff weren't coming back because they were getting paid more money to sit at home. The question now is at the end of July, that runs out. And what is the government going to do? If they pull that back and 40% of the population loses that $2,400 a month extra they were getting from the federal government, that could have a significant impact on the market. It could really dry up consumer demand, which has been very robust over the last 2 months. And that, in my opinion, would indicate a downward move in the equity market. And you would think that would be positive for the metals, but I think people, again, will raise cash. So at these levels here, at 1825 gold, 1925 silver, I think it's possible we may see some weakness in the short term. And by weakness, I think it'll be very contained. Maybe, gold could get back down to 1750, and maybe silver could get back down to low 18s. But I'm sticking with my target that by September, I think we see gold at or above the 2011 high, and silver then should be in around the $20-21 range. And then from here, I think the bull market continues because I think the central banks in the world are just going to keep throwing liquidity into it. And I think the bull market in the metals actually has just begun.
So that's exciting. You mentioned by September, the 2011 high for gold. And then silver, I think a lot of people are going to scratch their head and go, why only $20? Why only, $21? And I think that's just the overall question. Why is silver lagging gold in this environment? What are your thoughts on that? And do you see that going into, a next phase as the capital starts to move out to the fringes?
Well, I think the primary catalyst from a demand perspective for silver in this economic environment has to come from the investor side. Because the industrial side, for example, the solar panel industry is basically working at 20% capacity. A lot of the industrial usages for silver are still being impacted by the slowdown in economic activity on a global basis. Now, if the economies start to rejig and manufacturing comes back in and moves from sort of the 30% base it's at now to 60% base, totally agree. I mean, silver is a gem right here at $19, and it could easily go to $25, $30 with gold, taking out the 2011 high of 1925. But it's the industrial demand side that is still weak, and that's holding back silver to some extent.
Peter, I got to ask you about silver, or not specifically silver, but premiums. What's going on the supply side? When it comes to what happened with the spot price getting, collapsing, essentially, we, as far as retail goes, buying physical hasn't changed a whole lot between, $12 silver, $19 silver. It's been about the same in terms of actually being able to purchase, access, and so the upside for someone who bought physical silver, I mean, we're not really looking for $19 silver. I mean, we need $35, $40, $50 silver for us to really start to say, okay, it's meaningful. We're fine selling at spot, whatever the dealers are willing to give us at spot price. I mean, we'll be super happy. We won't be scrounging for, a point or two here and there because, we'll be well in the money. But at this point, the premiums have been up and down, which kind of lets me know that there really was no physical market at $12 silver. I mean, that's been my thesis on this. So anyways, go ahead and take it from there.
Yeah, I mean, I got a lot of flack, and it wasn't flack from investors. I got a lot of flack from dealers. We came out in I may be off a couple of weeks or even a month here. I don't know if it was March or April when when the pandemic was at its height at the very beginning, when everything was shut down. There were two issues in the physical market. One issue that nobody paid any attention to was logistics. And the issue with logistics is that, the silver and gold markets are global and supplies are global. And a lot of this product has to find its way onto an airplane and move around the globe. And there were no planes flying. So getting freight space on a plane was virtually impossible. And the pricing on that freight was anywhere from 5 to 10 times what it normally was, because obviously supply and demand. Instead of having 1,000 planes to choose from, you had two. And you had all the dealers, trying to move product into Asia, into Europe, and vice versa, Europe coming back into North America. So that caused a spike in the premium only because of the cost of logistics. The second issue was that most of the global mints, including the US Mint, the RCM, the Perth Mint, the Austrian Mint is relatively small, the British Royal Mint, they all shut down. They were shut down for 4 weeks, COVID. They literally had no production going on. So you had the price of the metal down at a relatively low level, $14 silver, 1,500 gold. Demand coming in because of the stimulus package, and the mints not producing product. So that spiked the premiums as well. Again, supply and demand. If I'm the only guy that has silver eagles, I can charge what I want for them. What we did in March is we told our clients, do not buy physical metal. Stay away from it entirely. You have to be out of your mind chasing silver eagle premiums at $12 to $15. Even at a $15 silver, I mean, you're at 25, 26 before you break even. Gold premiums on buffaloes and eagles were trading at anywhere as high as 200. I saw some dealers at 250 over spot. Again, absolutely absurd. Now, what we suggested to our clients was buy a product, and again, that's why the dealers were probably upset with us. Kitco had two products. We have a digital gold product and silver product that is allocated physically at the Royal Canadian Mint. And the premiums on that were about 30 cents on silver, and on gold was about $20. I said, if you like the price here at silver 15 and at gold at 1,500, buy this product. It'll be a matter of time. Now, the matter of time could be a month, could be 2, could be 3, but these premiums will come back down. And when they do, we'll just switch you out of this product and then deliver the physical to you, and then you pay your normal premiums. Now, right now, today, on gold maple leafs, gold eagles, gold buffaloes, the acquisition premiums by the dealers and silver maple leafs is identical to where it was pre-COVID. So right now you can pick up a gold eagle at about $75, $80. Given the fact that gold's at $1,800, the US Mint issues these coins at 3%, so that's about $60, give or take. So you're paying about a $25 premium over US Mint issued to the distributors, which is a consistent premium, and that was sort of the margin of premium that existed pre-COVID. Now, silver eagles are still a little tight, but again, they were trading at $15 premiums. You can pick up silver eagles on the wholesale market now at about $5. Mm. So,
but it's interesting because it never really got off of that $25 price point. Let's say for silver eagle, just call it $25.
Well, that's not true. You could have bought it at 15 in the digital. And then right now you could swap them out for $5 and you would have paid a round turn for 20.
That's
as
brilliant.
Opposed to paying 25, 27.
So why would you say that the spot price went down so low? I mean, do you have any insight on that as to why it was going down so low? And
when you say spot, why silver dropped in early March to
yes,
like 14 and change, and why gold dropped to 1,500?
I mean, I know you addressed that some, but would you at least why would it go down so much if there's such a shortage of supply? I mean, you have the logistics, all the things that you talked about, all the things that the retail demand felt. Why did the spot price go down so much despite that?
Okay, so you're holding physical silver, you're holding physical gold, and you just lost your job. Stock market drops 10,000 points. Next thing that was likely to go was the housing market. I mean, that's sort of the psychology. I need cash. I need something liquid. You're going to sell your stocks after a 40% drop? You're probably not. So what do? You're going to look for liquidity, and gold and silver are liquid. When they got scared right at the beginning and everybody thought this was it, the economy was just it's over, people were looking to raise cash. And what they did was they sold their precious metals because they were liquid.
So would you say that the dealers were
sale,
taking advantage?
No, it's not the dealers. It's not the dealers that make the market. Like I can't control the silver market.
Right.
And I know there's a big contingent of investors out there that believe in manipulation. I don't like using the word manipulation. Now, are there big houses that front run a market in metals? Absolutely. They do it in stocks. I mean, unfortunately, it's a big boys party, and you wear your big boys pants, and that's what happens in the market. Is it fair to the small investor? Absolutely not. But one thing people never understand when I try to make this comment, they keep talking about J.P. Morgan controlling the silver market and just hammering the silver market down. But it's not possible for J.P. Morgan to sell silver without there being a buyer on the other side. You cannot sell a silver futures contract unless there's a bid. So somebody is taking that position as JP Morgan sells the position. You're not just selling it into a vacuum. Now, JP Morgan could be selling hundreds of metric tons of silver. So just that supply coming on with the demand being less than that is going to drive the price down. But again, silver's at $19.25. JP Morgan, if they're short at $14, has got a massive book loss. They have to report. And it goes against their reserves. I mean, they can't just run a naked short position at a $5 pop in silver if they're short 50 million ounces of silver. They're going to be out $250 million on their balance sheet. So it's not that simple. There are big dealers out there that will take advantage and sell volume into the market, and that'll move the market. But the overall trend can never be reversed by a dealer. You have to trend, because this is a global market. It's not controlled by JP Morgan. You've got Chinese central bank buying, Russian central bank buying. You have massive institutions that are also buyers of this product. So you can't just have one firm that controls the market and just destroys it. It's just not feasible.
Absolutely. Yeah, there's definitely nuance, and we can't just buy into one story completely. I mean, there's just so many things at play here. And I loved your practicality and your solution for people for when premiums were rising. And, I know there's other products out there, but I mean, Kitco had that option for people, and it's a brilliant thing that you advise people to do. So do you cover the mining stocks much? I mean, any idea on kind of where we are with the miners? I mean, your opinions on those? Just kind of what's happening with metals, and then just the fallout on miners. Their bottom line's going up. I mean, they're going to be making more money.
They are.
And ultimately, investors are going to realize this, despite, maybe being burned over the last so many years and their experience with them.
I mean, if you're a spec, I've never, again, being in this market since '74, I've never really played the junior miners. We sort of had a philosophy that I was taught all the way since the beginning of this market being a tradable market, that if you buy junior gold or silver miners, if you buy 10, expect 9 to go to 0, and maybe you get a home run on the 10th. So if you buy mature producers that have positive cash flow, and the streaming companies, we've been extremely bullish, the streaming companies for the past, almost 7 years. Gold, Wheaton is just a perfect example. I mean, the stock is trading at 200% above where it was trading in March. Those stocks, I think, continue to perform well. The Barracks, the Newmonts, the big players that have proven reserves, that have positive cash flows, I think are going to benefit. Now, the juniors are going to go along for the ride, but I consider that a spec market. So you're going to get something where you get a junior popping from $1 to $1.80, but it could just as easily be back at $1.20 the next day. Because again, they're not producing. They have property. They have a survey that says there's gold in the ground, but now they've got to raise the money to go get that gold. So these guys cross their fingers. Either they can raise the money, and that's becoming much more difficult generally in the market, or they're hoping that some big producer will look at their property and say, you're close to where we are. We know there's a good gold reserve in there, and they make a deal and they buy them out. So that's what a junior does. They cross their fingers, roll the dice, and hope somebody comes along and takes them out at 3 times book. Again, that's a spec market. I'd rather go to the casino and bet on black or red on the roulette table. I think your odds are better.
Peter Hugg, everyone of Kitco. Peter, thank you so much for coming on the show and sharing your insight. And I think you really shed some light and some additional angles of nuance on the markets that, we haven't heard a whole lot about. So I really appreciate that. If people want to learn more about you and Kitco, where can they go and what can they expect to find?
Well, Kitco, and I don't want to, honk our horn, is very unusual in the industry. I may have said that to you the last time we were speaking. There's a variety of gold dealers that provide precious metals quotes, online. Where Kitco is unique, and there really is a Chinese wall with Kitco's operational side and our media side, is our Kitco.com site for clients that are looking for information, and they may not like the information they're getting. We have analysts on there that are bullish, and we have just as many that are bearish, and they give their opinions and they back up why they believe they're bearish or bullish, the same as Kramer would do on his stock thing at night. But it gives you information. It gives information on all the mining companies, but it gives information on where some of the bigger players in the market perceive the precious metals prices are going to go. You can then analyze it, make your own decision. But as far as information goes, you're not going to find a better site that is totally neutral. Media doesn't take a position, doesn't propose bullish. Every dealer you go to is bullish because being bearish doesn't make them any money. You're going to get a balanced view of what global people in this business think about the market. And then you at least have something to base your decision on, as opposed to some guy saying, Chicken Little, the world's going to end. Gold's going to $15,000 an ounce. Sell everything you have, including your firstborn, and buy gold. And they've been saying it since 1974. So, if you want to believe these guys and get caught up in the hype, go for it. If you want to hear some intelligent analysis of the market and then make your own decision, I think that's a smarter way to go.
Good deal. Well, appreciate that. Peter, thanks for coming on the show with me today. And we'll have this up here in short order.
Great, Kenneth. It's been a pleasure to be here again.